How is investing in stocks different from mutual fund investments? Investing in stocks. Stocks are financial instruments issued by companies that give the investor part ownership in a company. This entitles the owner of the stock to a portion of the company's assets and profits in proportion with how much stock they own. Units of stocks are called shares. Investing in mutual funds. Mutual funds are professionally managed investment schemes that pool in money from you and other investors and invest it in various securities like stocks, bonds, cash, etc. When you buy a unit of mutual fund, you're purchasing a part of the fund portfolio's value to the precise. The mutual fund house issues units to the investors based on the money invested by them. Risk involved in stocks and mutual funds. The stocks that you purchase has to face risks like headline risk, credit rating risk, risk of obsolescence, detection risk, commodity price risk, interest risk, and inflation risk. Whereas you as an investor have to face risks such as company risk, market risk, interest rate risk, regulator risk, inflation risk, liquidity risk, and taxability risk. On the other hand, mutual funds are considered risky because they invest your money in securities whose values tend to keep fluctuating due to dynamic market movements. However, since mutual funds invest in diverse securities of different sectors, they diversify the market risk. Now, what determines the capital gain loss in stock versus mutual funds? As far as capital loss or gain through stocks is concerned, the market price of the stock at the time of selling and purchasing is what decides the profit or loss on the share sale. For mutual funds, it's the NAV price at which you purchase and sold the mutual fund units which determine the capital gain or loss. If your chosen mutual fund scheme witnesses capital appreciation at the time of the sale versus the NAV at the time of purchase, you can book capital gains. Whereas if the NAV is running lower than the purchase NAV and you decide to sell the mutual fund units, you will incur a loss. Investing in mutual fund versus investing in stocks. Investing directly into a stock of a company is completely different ball game when compared to investing in a mutual fund. As stocks involve direct purchase of shares of the listed companies, this direct route involves much higher risk. On the other hand, investing in mutual fund implies that you buy a unit of that mutual fund, and it's the fund manager who takes a decision on your behalf regarding which securities to invest your money in, like bonds, stock, T-bills, etc., and form the mutual fund portfolio. This makes the risk in mutual funds lower. That's why it's often advised that new investors who wish to invest in stock market should ideally invest in mutual funds, as they tend to involve relatively lesser risk and benefits from the presence of professionals and experts in the form of fund managers. Being a novice and directly investing in stocks can land you into losses due to wrong decisions. Moreover, you can always approach financial advisors whenever you feel unsure or stuck when investing or planning to invest in stocks and mutual funds. It's better to benefit from their expertise rather than solely relying on guesswork.